Legal disclaimer. The content presented in this video, including all audio, text, and visual elements, is strictly for educational, informational, and entertainment purposes only. It does not constitute financial, investment, legal, tax, or trading advice. Foreign exchange Forex. Trading involves a significant level of risk and is not suitable for all investors. The high degree of leverage available in Forex markets can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. There is a possibility that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. Specifically regarding the topic of algorithmic trading and AI bots, historical performance of any trading system or methodology is not necessarily indicative of future results. No representation is being made that any account will, or is likely to achieve profits or losses similar to those discussed. The AI and bots discussed may refer to hypothetical simulations or third-party software, which the content creator has not verified for code integrity. You are solely responsible for your own due diligence. Consult with a licensed independent financial advisor before making any financial decisions. Let's be honest. You have seen the ads. You are scrolling through your feed at 11 p.m., and you see a chart going straight up. There is a screenshot of a dashboard showing all blue numbers, profit after profit, with a caption that reads, "I made $5,000 while I was sleeping." They tell you it is the latest artificial intelligence. They tell you it is a set-and-forget passive income machine. They tell you that the algorithm has cracked the code of the banking sector. And for a split second you believe it. You want to believe it. The idea of decoupling your time from your income, of having a machine battle the trillions of dollars flowing through the global currency markets while you enjoy your life, is the ultimate financial fantasy. But here is the cold, hard reality that those flashy advertisements will never ever tell you. Most retail Forex trading bots are not artificial intelligence. They are not advanced neural networks learning from the market in real time. They are simple, fragile instruction scripts that work exceptionally well in one specific market condition, and then proceed to wipe out your entire trading account the moment the wind changes direction. There is a reason why institutional trading firms spend hundreds of millions of dollars on infrastructure, colocation servers, and PhD-level data scientists to build their algorithms, while you are being sold a revolutionary bot for a one-time payment of $197. If a bot truly printed money with zero risk, nobody would sell it to you. They would run it themselves, compound the capital, and own the market. The fact that it is being sold to you is the first red flag, but it is not the only one. We are about to open a door that usually stays firmly shut. We are going to look at the mechanical, statistical, and brutally honest reality of how these automated systems function. We are not here to sell you a bot. We are here to dismantle them. We are going to look at the black box paradox. This is the phenomenon where a trader hands over their capital to a piece of software they do not understand, trusting a logic they cannot see. When you drive a car, you understand that turning the wheel left makes the car go left. When you use a typical AI Forex bot, you are essentially blindfolded in the passenger seat of a car that is speeding down the highway at 100 miles per hour, hoping the invisible driver knows that there is a sharp turn coming up in half a mile. The danger involves what we call curve fitting. This is a statistical trap where a bot developer looks at past market data, let's say the price action of the euro against the US dollar for the last 6 months, and tweaks the settings of the bot until it looks like it would have made a fortune during that specific period. They over-optimize the parameters to fit history perfectly. It is like predicting the lottery numbers for yesterday's draw. It looks impressive on paper. It looks flawless in a backtest report. But the moment you turn it on with real money in a live market, the market does what it always does. It changes. It evolves. The volatility shifts. The correlations break. And because that bot was curve-fitted to the past, it suffocates in the present. The drawdown begins. It starts with a small loss, perhaps 2%. Then the recovery function kicks in. Often a dangerous martingale strategy that doubles the bet to win back the loss. Suddenly you are down 10%. Then 30%. Then you get a margin call. The bot didn't break. It did exactly what it was programmed to do in a market that no longer exists. This series is your inoculation against the hype. We are going to dissect the architecture of these systems. We need to distinguish between true machine learning, which is complex, adaptive, and incredibly rare in the retail space, and standard algorithmic trading, which is rigid, rules-based, and common. When you understand the difference, you become immune to the marketing. You stop looking for a magic box and start looking for a tool. And that is a crucial distinction. A hammer is a tool. In the hands of a master carpenter, it builds a house. In the hands of a toddler, it breaks a window. A trading bot is a hammer. The problem is that most people buying them are toddlers in the world of financial market structure. Over the course of this deep dive masterclass, we are going to peel back the layers of complexity. We will explain exactly how execution algorithms work, how they slice orders to hide from other market participants. We will talk about high-frequency trading, HFT, and why your home internet connection renders you obsolete before your trade even reaches the broker's server. We will look at the role of latency, the speed of light, and how physical distance from the exchange affects your bot's performance. We will discuss alpha, the actual edge a strategy has versus beta, which is just riding the market's movement. But most importantly, we are going to address the why. Why do these bots fail so often? It is not always a scam. Sometimes it is a misunderstanding of market microstructure. For example, did you know that the price you see on your screen is not necessarily the price your bot can execute at? This is called slippage. In a fast-moving market, your AI bot might send a signal to buy at 1.0500. By the time that signal travels through the internet, reaches your broker, gets matched with a liquidity provider, and is confirmed, the price might be 1.0502. That 2 pip difference might not sound like much, but if your bot relies on scalping 5 pips of profit, slippage just ate 40% of your potential gain. Over thousands of trades, this friction destroys the mathematical expectancy of the system. This is the invisible killer of retail bots. It isn't a bad strategy. It is a bad execution environment. We are also going to tackle the psychology of automation. There is a misconception that using a bot removes emotion from trading. This is false. It simply shifts the emotion from fear of pulling the trigger to fear of the machine. Watching a bot enter a trade that is going against you and debating whether to intervene or trust the process is a unique form of psychological torture. If you intervene and close the trade, and the market then reverses and would have hit profit, you feel like an idiot for breaking the system. If you do not intervene and the bot drains your account, you feel like a victim. We will discuss how to manage the manager, how to act as a supervisor to your automated employees, rather than a helpless bystander. We will also explore the legitimate side of this technology, because, make no mistake, algorithms dominate the modern financial landscape. Roughly 70% to 80% of all trading volume in US equities, and a massive portion of Forex volume is driven by machines. They provide liquidity, they correct inefficiencies, and they arbitrage price differences across global exchanges. Real AI in trading does exist. It uses natural language processing, NLP, to read central bank statements in milliseconds and gauge sentiment. It uses regression models to predict volatility clusters. It helps hedge funds manage risk exposure across thousands of positions simultaneously. This technology is real, powerful, and fascinating. But it is vastly different from the $50 expert advisor being hawked on social media. By the end of this video, and certainly by the end of this series, you will no longer be the target audience for predatory bot sellers. You will be a sophisticated market participant who understands the limitations and the mechanics of automation. You will understand that AI is a buzzword, but statistical arbitrage is a strategy. You will know that passive income is a myth in trading, but systematic trading is a profession. We are going to strip away the varnish and look at the raw wood underneath. We are going to look at the code, the logic, and the math. So, if you are looking for a guarantee of riches, you are on the wrong channel. If you are looking for a promise that you can quit your job tomorrow and let a robot pay your mortgage, you should click away now. But, if you are ready to understand the complex, messy, and incredibly interesting way that computer code interacts with human greed and fear in the largest financial market on the planet, then you are in the right place. We are going to start from ground zero. No assumptions. No jargon left undefined. Just the truth about how machines trade money. Let's begin by defining the playing field. Before we can understand the bot, we have to understand the arena it fights in. This is part 1 of your masterclass on AI Forex trading bots. Welcome to the deep end. To understand the arena, you must first understand the gladiator you are sending into the pit. When you download a trading bot or purchase one from a slick landing page, you are rarely getting a sophisticated artificial intelligence. You are getting what the industry calls an expert advisor, or EA for short. The distinction between an EA and true AI is not just semantics. It is the difference between a pocket calculator and a human brain. And understanding this difference is the single most important factor in protecting your capital. Imagine for a moment that you are teaching a robot to cross a busy street. If you build an expert advisor, you give it a strict set of rigid rules. You code a line that says, "If the light is green, walk." This works perfectly in a simulation where the only variable is the traffic light. But now, put that robot on a real street in New York City. The light turns green, so the robot begins to walk. But suddenly, an ambulance speeds through the red light. The expert advisor does not see the ambulance because you did not code a rule for ambulance. It only knows if green, walk. The result is a catastrophe. The robot is destroyed because it followed its rules blindly, ignoring the context of the environment. This is exactly how 99% of retail Forex bots operate. They function on if-then logic statements based on lagging indicators. The code looks something like this. If the relative strength index, RSI, drops below 30, then open a buy order. If the 50-period moving average crosses above the 200-period moving average, then close the sell order. It is linear. It is static. It is entirely dependent on the assumption that specific mathematical conditions will always yield the same result. But the Forex market is not a traffic light simulation. It is a living, breathing ecosystem driven by geopolitical events, central bank interest rate decisions, and institutional liquidity flows. Let's look at a specific case study to illustrate why this fails. Consider the classic trend-following bot. This is one of the most common architectures sold to beginners. The logic is seductive in its simplicity. The bot waits for a strong move in one direction, say the British pound rising against the Japanese yen, and then jumps in to ride the wave. In a clean, strong bull market, this bot looks like a genius. It buys every dip, and the price keeps making higher highs. The user looks at their account balance and sees it growing by 5%, 10%, 20% in a month. They start calculating how long until they can retire. But then the market enters a ranging or consolidation phase. The price stops trending up and starts bouncing sideways between two levels. The trend-following bot, however, does not know the market has changed. It sees a small move up and thinks, the trend is resuming. Triggers a buy order. Immediately, the price hits the top of the range and reverses down. The bot hits its stop loss. Then the bot sees the price moving down and thinks, new downtrend detected. It triggers a sell order. Immediately, the price hits the bottom of the range and bounces up. The bot hits its stop loss again. This is called the whipsaw. In a matter of days, a bot that made profits for 3 months can give back 100% of those gains because it is trying to apply trend logic to a sideways market. It is like trying to drive a Formula One car on a rocky off-road trail. The machine isn't broken. It is just the wrong tool for the terrain. And because these EAs lack consciousness or genuine adaptability, they will continue to execute that losing logic until your account balance hits zero. They will trade you into the ground with efficient robotic precision. Now, compare this to true machine learning or neural networks. This is what marketers claim they are selling you but almost never are. A true AI does not follow a strict if-then rule set. Instead, it consumes vast amounts of data, price action, volume, time of day, perhaps even news sentiment, and looks for nonlinear patterns. Trains itself. Imagine that same robot crossing the street. A machine learning model would not just look at the light. It would analyze the speed of approaching cars, the weather conditions, and the movement of other pedestrians. If the light turns green but it detects a fast-moving object approaching, it calculates a high probability of a collision and chooses to wait. It adapts. However, even true AI has a fatal flaw in trading, and this is the honest look we promised. It is a problem called overfitting. Imagine you show an AI thousands of pictures of dogs to teach it what a dog looks like. But in every picture you show it, the dog is wearing a red collar. The AI might incorrectly learn that dog equals animal with red collar. If you then show it a dog with a blue collar, it says not a dog. In trading, we feed the AI historical data. We show it 5 years of the euro/dollar chart. The AI might learn that every time the price drops on a Tuesday morning at 8 a.m., it bounces back up. It identifies this as a high probability pattern. So you turn it on live. But that pattern on Tuesday mornings wasn't a universal law of economics. It was just a coincidence caused by a specific central bank meeting schedule that has since changed. The AI has memorized the past rather than learning the underlying dynamics of the market. When the future doesn't look exactly like the past, the AI fails. This brings us to the black box problem. When you buy a bot, the vendor usually locks the code. You get a file, often in .x4 or .x5 file if you are using MetaTrader, that you cannot open or read. You are essentially handing your wallet to a stranger in a dark room. You do not know if the bot is risking 1% or 10% per trade until it actually opens a position. You do not know if it uses a martingale strategy, a dangerous technique where the bot doubles the trade size after a loss to try and recover the money. Let's play out an imagine-if scenario that happens to thousands of traders every year. Imagine you buy a bot that uses martingale logic. You deposit $1,000. The bot buys euro to US dollar. The price drops. The bot buys more at a lower price, doubling the size. The price drops again. Buys again, doubling again. The logic is, eventually the price must turn up, and when it does, the massive size of the bottom trade will cover all the losses of the top trades. It works beautifully for months. You feel like a genius. But the market has a nasty habit of trending further than you can remain solvent. One day, a major geopolitical crisis hits. The euro crashes and does not bounce for 500 pips. The bot keeps doubling down. Your floating loss, the loss on open trades, grows. Minus $100, minus $300, minus $800. Suddenly, you get a notification from your broker. Your margin level has dropped below 50%. The broker forcibly closes all your trades to cover the debt. You have been stopped out. Your balance is $0. The bot technically didn't lose. It just ran out of your money before the market turned around. This is the mechanical reality. The bot is just a script executing code. It has no fear. It has no hesitation. And crucially, it has no awareness of risk beyond what is hard-coded into it. It does not know that the non-farm payrolls report is coming out in 5 minutes. It does not know that a war just broke out. It only knows RSI is below 30 by. So, if simple scripts fail because they are too rigid and complex AI fails because it overfits to past data, does anything work? Yes, but it requires a shift in perspective. The professional algorithmic traders, the quants on Wall Street, do not look for a bot that predicts the future. They look for bots that exploit inefficiencies. They are not trying to guess if the price will go up or down. They are trying to be faster than you, or to find a price difference between London and New York that lasts for a millisecond. But for the retail trader, for you watching this, the danger is in the data. You see, the sellers of these bots know exactly how to manipulate the data to make a broken, if then script look like a money printing machine. They can take a bot that would have lost money in 2021, 2022, and 2024, and present you with a chart showing a straight line of profit up to the moon. How do they do it? How can they legally show you results that are technically real, but completely deceptive? It involves a trick of time travel called backtesting manipulation. They simulate the past, but they rig the game. They cherry-pick the dates. They ignore the spread. They delete the losing trades from the history log before taking the screenshot. And worse, they use a specific type of data quality that is so poor, it invents profits where there should have been losses. You might be looking at a performance chart right now on a website thinking it's proof. But what if I told you that chart is a mathematical lie? What if I told you that the beautiful upward curve you are looking at is actually a record of a bankruptcy waiting to happen? To understand how you are being tricked, we have to go behind the curtain of the simulation itself. Welcome to the laboratory of illusions. In the world of algorithmic trading, this laboratory is called the strategy tester. It is a piece of software included in most trading platforms like MetaTrader 4 or 5 that allows you to run a robot over historical data to see how it would have performed. On the surface, this sounds logical. If a strategy worked for the last 5 years, surely it has some merit, right? This assumption is the trap. The strategy tester is not a lie detector. It is a storytelling machine. And if you feed it the wrong parameters, it will tell you exactly the fairy tale you want to hear. Let's break down the mechanics of the deception. The primary method used to fake results is a flaw in data quality and interpolation. This gets technical, but stick with me because this single detail is responsible for millions of dollars in retail losses. A price chart is made up of candles or bars. If you are looking at a 1-hour chart, each bar represents 1 hour of time. The data file tells the computer 4 things about that hour: the open price, the high price, the low price, and the close price, OHLC. That is it. It does not tell the computer what happened inside that hour. Did the price go straight up? Did it crash down and recover? Did it zigzag wildly? The simulation software doesn't know. So it guesses. This guessing process is called interpolation. The software creates a fake smooth path from the open to the high to the low to the close. It connects the dots with straight lines. Now imagine a scalper bot, a robot designed to take tiny profits of 5 or 10 points. In the simulation, the software assumes the price moved smoothly, so it triggers the bot's buy order, moves the price up smoothly to the take profit level, and closes the trade. Win. But in the real world, inside that 1 hour, the market was chaotic. The price might have spiked down first, hitting the bot's stop loss, before eventually going up. In reality, the trade was a loss. In the simulation, because the software ignored the jagged noise inside the candle, it recorded a win. This is how you get 99% win rate bots. They are winning against a simplified, imaginary ghost of the market, not the jagged, violent reality of actual price action. Unless the developer uses 99.9% modeling quality with real tick data, which records every single micro-movement of price, the backtest is worthless. And yet, almost every screenshot you see on sales pages uses the low-quality, interpolated method because it turns losers into winners. Then there is the issue of the fixed spread. In the Forex market, the spread is the cost of doing business, the difference between the buy price and the sell price. It is how brokers make money. In a live environment, the spread is dynamic. It breathes. When the market is calm, the spread is tight, maybe 1 pip. When news breaks, like an inflation report or a war announcement, the spread explodes. It can widen to 20 or 30 pips in a millisecond. A dishonest bot seller will run a backtest with a fixed spread setting. They will tell the simulation, assume the spread is always 1 pip. The bot runs through 5 years of history. It trades through Brexit, through elections, through pandemics. In the simulation, it executes trades during these volatile events with a tiny 1 pip cost and makes a fortune. But in the real world, during those exact moments, the spread was actually 20 pips. The trade that the simulation records as a $50 profit would have actually been a $150 loss the instant it opened. By simply hiding the variable spread, the vendor constructs a track record that is mathematically impossible to replicate in a live brokerage account. Let's look at a case study of over-optimization, or what we called curve fitting earlier, but let's look at the mechanics of how it is done. It uses something called a genetic algorithm. This is a tool available to developers that runs millions of combinations of settings automatically. Imagine a developer wants to sell a bot. They have a basic strategy. Buy when the price moves up. They load this into the optimizer. The computer starts testing variables. It tests a stop loss of 10 pips, then 11, then 12. It tests a take profit of 20, 21, 22. Tests trading only on Mondays, then only on Tuesdays. It runs through millions of iterations at lightning speed. Eventually, the computer finds a bizarre combination of settings that, by pure luck, would have made millions of dollars over the last year. Maybe the magic combination is stop loss 13 pips, take profit 42 pips, only trade on Wednesdays between 2 a.m. and 4 a.m., but only if the RSI is exactly 34. Does this combination make economic sense? No. Is there a fundamental reason why the market moves exactly 42 pips on Wednesdays at 2 a.m.? No. It is just statistical noise. It is a random pattern in the data that the computer found. But the developer takes this optimized setting, saves it, and sells it as a precision-engineered Wednesday breakout strategy. When you buy this and run it, you are betting that a random lucky coincidence from the past will repeat in the future. It won't. The moment you turn it on, the Wednesday anomaly disappears, and the bot bleeds money. The developer isn't necessarily a genius. They are just a sniper who shot a bullet into a blank wall, and then painted a target around the hole afterwards to claim they hit a bullseye. Now, consider the survivorship bias in commercial bot marketplaces. There are websites where anyone can upload a signal or a bot for others to copy. You might see a top-rated list showing bots with 500% returns in the last 3 months. This looks compelling, but what you do not see is the graveyard. For every one bot that appears on that top-rated list, there were 100 others launched by the same developer that blew up and were deleted. These developers play a numbers game. They launch 50 different high-risk bots with slightly different settings. 49 of them crash and burn within a month. They delete those accounts. No one sees them. But one of them, purely by chance, gets lucky and doubles the account 3 times in a row. That single survivor is then marketed to you as the Holy Grail. You are looking at the lottery winner and assuming buying a ticket is a valid business strategy. You are seeing the outcome of luck disguised as the outcome of skill. This leads us to the most dangerous imagine-if scenario for a retail trader. Imagine you have found a bot that actually works. You did the due diligence. It uses tick data. It survives variable spreads. It is not over-optimized. You buy it, install it, and fund your account with $5,000. You wake up the next morning expecting profit. Instead, you see a loss. You check the charts. The bot bought euro to US dollar at 1.1000, but the chart shows the price never reached 1.1000. It only went down to 1.1005. Why did your bot execute a trade at a price that doesn't exist on the chart? Or perhaps the bot tried to close a trade at a profit, but the broker rejected the order, waited 3 seconds, and then closed it at a loss. You look at the log files and see an error message, off quotes, or slippage. You have just encountered the final boss of automated trading. It is not the code. It is not the strategy. It is the entity that stands between you and the market. You see, a trading bot is just software sending a request. Please buy this. But the person on the other end, your broker, has no obligation to honor that request at the exact price you want, or even at all. You might have the perfect Formula One car, the bot, and you might have mapped out the perfect track, the strategy, but if the race organizer, the broker, decides to pour oil on the road right in front of your tires, you are going to crash. There is a dirty secret in the retail forex brokerage industry called the B-book. It fundamentally changes the relationship between you and your trading bot. In the B-book model, your broker is not sending your trades to the real market. They are taking the other side of your bet. When your bot wins $100, the broker loses $100. When your bot loses $100, the broker keeps it. Think about the incentives here. You are running an automated machine designed to extract money from the market. If your broker is the one paying you, do you think they are going to let a highly effective bot drain their bank account without a fight? We need to talk about hybrid execution, virtual dealer plugins, and how brokers can artificially induce lag to trip up your algorithm. We need to explain why a bot that works on a demo account, where the broker simulates perfect conditions to hook you, suddenly falls apart on a live account, where the broker applies the real friction. You aren't just fighting the market, you are fighting the infrastructure itself. And in the next part, we are going to expose the tricks brokers use to kill profitable bots, and how you can spot a toxic broker before you deposit a single cent. You are entering the engine room of the casino. If you understand this next section, you will understand why a trading bot can be programmed with genius-level code, possess a statistically valid strategy, and still lose money every single month. It is not the bot's fault. It is the environment in which it is trying to survive. To grasp this, we have to look at the business model of the entity holding your money, the broker. In the retail forex industry, there is a fundamental dividing line between two types of execution models, the A-book and the B-book. Understanding which side of this line you are on is often more important than the strategy your bot is running. Let's start with the A-book. This is the legitimate, transparent model. When your AI bot sends a buy order for one lot of euro to US dollar, an A-book broker, often called an ECN or STP broker, takes that order and instantly passes it through to a liquidity provider, usually a major bank like JP Morgan, Deutsche Bank, or a non-bank market maker like Citadel. The broker is just a bridge. They charge you a commission, say $7 per round trip, and that is their profit. They do not care if you win or lose. If you make $1 million, great, you will keep trading and paying them commissions. Their interests are aligned with yours. They want you to survive. Now let's look at the B-book. This is the market maker model. When your bot sends that same buy order, the B-book broker does not send it to the real market. Instead, the broker takes the other side of the trade themselves. You are betting against the house. If you buy, the broker sells to you. If your bot generates a profit of $500, that $500 comes directly out of the broker's operating capital. If your bot loses $500, the broker keeps your money as pure revenue. Think about the conflict of interest here. You are asking a company to facilitate a tool, your bot, that is designed to take money away from them. In a B-book environment, a profitable AI bot is not a customer. It is a hostile parasite draining the company's funds. And unlike a Las Vegas casino, which has strict gaming regulations, offshore forex brokers have software tools designed specifically to neutralize this threat. This software is often referred to as a virtual dealer plugin. It is a back-end management tool that allows the broker to manipulate the execution of trades for specific clients. It is not a conspiracy theory. It is a feature listed on the spec sheets of brokerage technology providers. Imagine if you are running a high-frequency scalping bot. This bot relies on speed. It aims to snatch 2 or 3 pips of profit from tiny market movements, executing dozens of times a day. You deposit $1,000 into a B-book broker. For the first week, your bot is flying. You make $200. The broker's risk management algorithm flags your account. You are now classified as a toxic flow or a sharper. The broker system automatically adjusts the parameters for your specific account. It adds a delay to your execution. This is subtle, maybe just 200 or 300 milliseconds. To a human manual trader, a 300 millisecond delay is unnoticeable. You click buy, and a third of a second later the trade opens. Feels instant. But for an AI scalping bot, 300 milliseconds is an eternity. Here is the imagine if scenario. Your bot detects a breakout. The price of gold is surging. The bot sends a signal to buy at 2000.00. The signal hits the broker's server. The virtual dealer plugin sees the order, sees your toxic flag, and holds the order in a digital waiting room for 300 milliseconds. During that tiny pause, the price of gold jumps from 2000.00 to 2000.50. The broker then executes your order at the current market price of 2000.50. This is called slippage. Your bot targeted a 2-pip profit. It expected to buy at 2000.00 and sell at 2000.20. Instead, it was forced to buy at 2000.50. It is instantly in a loss. The edge is gone. The math is broken. And the beautiful part for the broker is that they can claim this is just normal market volatility. They can show you the logs. We executed the trade at the market price available at the time of execution. Technically, they are telling the truth. But they manipulated the time of execution to ensure the price was unfavorable. Gets worse. Let's talk about asymmetric slippage. In a fair market, slippage can be positive or negative. Sometimes you get filled at a worse price, sometimes at a better one. But in a manipulated B-book environment, the slippage is often asymmetric. If the price moves in your favor during the delay, the broker rejects the order and sends a requote message. The price has changed, do you want to accept the new price? By the time your bot or you accepts, the opportunity is gone. But if the price moves against you during the delay, the broker fills you immediately at the worst price. They capture the loss but deny the gain. This destroys the statistical expectancy of any AI system. If your bot wins 60% of the time, but the broker shaves 1 pip off every win and adds 1 pip of slippage to every loss, that 60% win rate mathematically turns into a net loss over time. The house edge is inserted into the code execution itself. Another trap is the spread widening during the rollover period. In Forex, the market technically closes for a few minutes at 5 p.m. New York time to settle accounts for the day. Liquidity drops. During this time, spreads naturally widen. However, predatory brokers will artificially explode these spreads to hunt for stop losses. Imagine your bot is holding a swing trade overnight. You are long euro to US dollar at 1.0500. Your stop loss is at 1.0450. The market is trading quietly at 1.0480. You are safe 30 pips away from your stop. 5 p.m. hits. The broker widens the spread on euro to US dollar to 40 pips. The ask price shoots up, but the bid price, the price you sell at to close a long position, drops like a stone. The bid price hits 1.0440 for 1 second. Your stop loss is triggered. Your trade is closed out for a loss. Then at 5:01 p.m. the spread returns to normal. The chart shows the price is back at 1.0480. If you look at a generic chart from a different data provider like TradingView or Bloomberg, the price never dropped to 1.0440. It only happened on your broker's specific data feed. This is a stop hunt. Your bot did everything right. The analysis was correct. The direction was correct. But the broker used the spread mechanism to reach into your account and liquidate the position. So how do you spot a toxic broker? You have to look at their regulation and their business model. If a broker is unregulated or registered on a tiny island you have never heard of, and they offer zero commission trading with raw spreads, run away. The math doesn't work. If they aren't charging you a commission, they must be making money from the spread, B-book, or your losses. Look for ECN/STP brokers regulated by Tier 1 authorities like the NFA/CFTC, USA, FCA UK, or ASIC Australia. These regulators mandate strict reporting. They audit the execution quality. They make it much harder, though not impossible, for brokers to play these games. An A-book broker wants high volume, profitable traders because they generate more commissions. A B-book broker wants beginners who lose their deposits quickly. The churn and burn model. But let's assume you navigate this minefield. Let's assume you find a pristine, honest, ECN broker with ultra-low latency and servers located in the Equinix New York 4 data center right next to the exchange. You have solved the infrastructure problem. You are safe, right? Wrong. Because even with the perfect broker and the perfect connection, there is a mathematical demon lurking inside the logic of many popular AI bots that guarantees, with 100% certainty, that your account will eventually go to zero. It is not a matter of if, but when. This demon is disguised as a strategy. It looks like the safest, most consistent way to trade. It produces charts that go up in a straight line for years. It is the most popular strategy sold on the internet. And it is a ticking time bomb. In the next part, we are going to dissect the martingale and grid strategies. We will explain the terrifying mathematics of negative progression and show you why a bot with a 99% win rate is actually the most dangerous thing you can ever install on your computer. Here is the dirty little secret of the algorithm market. The most popular, best-selling, and highest-rated bots on almost every retail marketplace are all built on the same flawed mathematical foundation. They are variations of the martingale or grid strategy. And the reason they are bestsellers is that they exploit a psychological loophole in the human brain. We are wired to hate losing. We perceive a loss as a failure. So developers build bots that technically never lose, until the day they lose everything. To understand why this is a ticking time bomb, we have to look at the mechanics of negative progression. In a standard trading strategy, if you take a loss, you accept it, your account dips slightly, and you move on to the next trade. In a martingale system, the bot refuses to accept the loss. Instead, it doubles down. Imagine you flip a coin. You bet $10 on heads. It comes up tails. You lose $10. In a martingale system, you now bet $20 on heads. If you win, you get $40 back. That covers your $20 bet and your previous $10 loss, and leaves you with a $10 profit. Seems like magic. As long as you have enough money to keep doubling your bet, you can never technically lose. You just keep doubling until you win eventually. Now apply this to Forex. A bot buys the euro at 1.0500. The market drops to 1.0480. The bot is down 20 pips. Instead of closing the trade for a loss, the bot buys again, but this time it buys twice the lot size. Now, the bot only needs the price to go up a little bit, to the break-even point in the middle, to get out of the mess with a profit. If the price drops another 20 pips, it buys again, doubling the size again. This creates an equity curve that looks incredibly seductive. It is a straight line sloping upward at a 45-degree angle. Every day is a winning day. There are no drawdowns on the closed balance. It looks like a money printing machine. This is why beginners flock to these bots. They see 99% win rate and think they have found the holy grail. But here is the imagine if scenario that destroys this fantasy. Imagine you are trading a standard account. You start with a small trade of 0.1 lots. The market trends against you. Trade 1 0.1 lots. Trade 2 0.2 lots. Trade 3 0.4 lots. Trade 4 0.8 lots. Trade 5 1.6 lots. Trade 6 3.2 lots. By the sixth trade, you are not trading small anymore. You are trading 3.2 standard lots. In the Forex market, that is $320,000 worth of currency. A 10-pip move against you is now costing you $320. But wait, it continues. Trade 7, 6.4 lots. Trade 8, 12.8 lots. Trade 9, 25.6 lots. By the ninth level of the grid, which can happen in a single day during a strong news event, you are holding a position size of over $2.5 million. A single pip movement against you is losing you hundreds of dollars. Your free margin, the collateral you need to keep these trades open, is evaporating. You are no longer an investor. You are a gambler praying for a market reversal. And here is the kicker. The market does not have to reverse. This is the gambler's fallacy. People believe that because the price has gone down for 10 days in a row, it must go up on the 11th day. This is false. In 2014, the euro trended down against the dollar for months without a significant pullback. In 2022, the Japanese yen collapsed against the dollar in a historic one-way move that lasted for weeks. During these events, martingale bots don't just lose, they implode. The bot keeps buying the dip, and the dip keeps dipping. Eventually, you hit a hard mathematical wall, the margin call. The broker's computer realizes you don't have enough cash to cover the potential losses of your massive 25.6 lot position. So, it forcibly closes all your trades at the worst possible moment. The result? Your account balance goes from $10,000 to $0 in a millisecond. That beautiful straight line of profits on the chart falls off a cliff. This is widely known in the industry as picking up pennies in front of a steamroller. You pick up penny after penny, small consistent wins, until the steamroller runs you over. Developers try to hide this risk by using soft martingale or grid systems. They might not double the lot size, maybe they multiply it by 1.5, or maybe they space the trades further apart. They call it cost averaging. It sounds sophisticated, sounds like prudent investment management. It is not. It is simply a slower version of the same poison. You are still adding to a losing position. You are still fighting the trend. You are still betting that your pocket is deeper than the market's volatility. Spoiler alert: the market's pockets are infinite. Yours are not. The deception runs deeper when you look at how these bots display their performance. There are two numbers in your trading account: balance and equity. Balance is the money you have from closed trades. Equity is the money you would have if you closed everything right now. A grid bot will often show a balance that is constantly going up. It closes the winning trades quickly to bank the profit, but it leaves the losing trades open, hoping they will turn around. So, you might see a balance of $15,000 but an equity of $8,000. That $7,000 difference is floating loss. It is real money that you have lost, but you haven't admitted it yet. The bot hides this floating loss in the background like dirty laundry stuffed in a closet. Eventually, the closet bursts open. Let's look at a specific historical catastrophe. The Frankerjetten of January 15, 2015. The Swiss National Bank suddenly removed the cap on the Swiss franc. In minutes, the franc soared in value. The euro to Swiss franc pair crashed over 2,000 pips. Grid bots that were buying the dip on euro to Swiss franc didn't just wipe out accounts. They put traders into debt. Because the move was so fast and the leverage was so high, the losses exceeded the deposits. Traders who started the morning with $5,000 ended the day owing their broker $20,000. This is the extreme risk of automated strategies that do not use a hard stop loss. So rule number 1 for filtering out dangerous AI bots: look at the equity curve. If it is a perfectly straight line with zero volatility, run away. Real trading is messy. Real strategies have losing days, losing weeks, and even losing months. A jagged equity curve that trends up over time is a sign of a healthy strategy that accepts losses. A smooth curve is a sign of a strategy that is hiding risk until the inevitable explosion. This brings us to the concept of risk of ruin. This is a statistical probability calculation. If you risk 20% of your account on a single trade series, which martingale often does, your risk of ruin is statistically near 100% over a long enough timeline. Even if you have a 90% win rate, that 10% chance of a loss will eventually occur. And when the penalty for that loss is total account wipeout, the probability of you eventually going broke is 1. We want to find bots where the penalty for being wrong is a slap on the wrist, not a bullet to the head. We need to pivot our search. We need to stop looking for bots that claim to predict the market or force the market to pay us. We need to look for bots that manage risk. The holy grail of trading is not a specific entry signal. It is not a magical indicator. It is a mathematical formula called positive expectancy, combined with asymmetric risk, reward. This means finding a bot that might only win 40% of the time, but when it wins, it makes $3, and when it loses $1. If you have a bot that loses 6 out of 10 trades, most beginners would say it's broken. But let's do the math. 6 losses x $1 equals minus $6.00. 4 wins x $3 equals plus $12.00. Net profit equals plus $6.00. This is a winning system. It loses more often than it wins, but it makes money. This is how professionals trade. This is how hedge fund algorithms work. They don't try to be right all the time. They try to be profitable over time. However, these bots are psychologically difficult to use. Can you handle watching a bot lose 5 trades in a row? Can you sit on your hands and not turn it off when you see red day after red day? Most people can't. They intervene. They tweak the settings. They break the logic. And this brings us to the next critical component of the puzzle. Once you abandon the martingale fantasy and accept that losses are part of the game, you are left with a new problem. How do you configure a bot to survive the drawdown period? How do you determine the correct lot size so that a string of 10 losses doesn't kill you? Most traders guess. They pick 0.1 lots because it feels right. This is reckless. There is a precise scientific formula for determining exactly how much to bet on every single trade to maximize growth, while keeping the risk of ruin near zero. It is a formula used by card counters in blackjack, and by quantitative analysts in major banks. It is called the Kelly criterion, and when applied to AI trading bots, it acts as a turbocharger for your equity, but only if you use it correctly. If you use it wrong, it is just another way to blow up. In the next part, we are going to leave the toxic world of martingale behind and enter the world of professional money management. We are going to learn how to calculate the risk of ruin, how to apply the Kelly criterion to your bot settings, and why position sizing is actually 90% of the secret to algorithmic success. Welcome to the mathematics of survival. Most traders, especially those new to the world of algorithmic trading, spend 99% of their energy obsessing over the entry signal. They want to know the exact combination of moving averages and RSI levels that will predict the next market move. They treat the buy button as the most important variable in the equation. They are wrong. The most important variable is not when you buy, it is how much you buy. This is the domain of position sizing, and it is the only mathematical shield you have against the uncertainty of the future. You can have a bot with a mediocre strategy, one that is basically a coin flip, and if you apply superior position sizing, you can still make money. Conversely, you can have a brilliant high-accuracy bot, and if you get the position sizing wrong, you will go bankrupt. To understand why, we have to look at the brutal asymmetric mathematics of drawdown recovery. This is a concept that is rarely explained in the marketing brochures for trading bots, but it is the governing law of your account balance. If your bot loses 10% of your account, you do not need a 10% gain to get back to break-even. You are now trading with a smaller capital base, 90% of the original. To get back to 100%, you need to generate a return of 11.1%. That doesn't sound too bad. But let's say your bot takes a bigger hit. Let's say you are running a slightly aggressive grid strategy, and you lose 50% of your account. You have $5,000 left of a $10,000 deposit. To get back to $10,000, you need to make $5,000. That is not a 50% gain. That is a 100% gain. You have to double your money just to get back to where you started. Gets worse. If you lose 90% of your account, which happens frequently with high-risk martingale bots, you are left with $1,000. To get back to $10,000, you need a 900% return. A 900% return is a statistical anomaly. It is nearly impossible to achieve without taking massive risks that will likely wipe out the remaining $1,000. This is why capital preservation is the first, second, and third rule of algorithmic trading. Once you dig a hole too deep, the math prohibits you from climbing out. This brings us to the fixed lot versus percentage risk debate. Many novice bot users set their software to trade fixed lots. For example, 0.10 lots per trade. This seems stable. It is actually a trap. Imagine you have a $10,000 account and you trade one standard lot. A losing streak hits, and your account drops to $5,000. If you are still trading one standard lot, the value of each pip is still $10. A 50 pip loss costs you $500. When you had $10,000, that $500 loss was 5% of your account. Painful but survivable. Now that you have $5,000, that same $500 loss is 10% of your account. As your account shrinks, the fixed lot size essentially increases your leverage and risk exposure. You are accelerating toward the cliff edge exactly when you should be hitting the brakes. Professional algorithms use dynamic position sizing. They calculate the risk as a percentage of the current account balance. If the rule is risk 2%, and you have $10,000, the bot calculates a lot size that risks $200. If you lose and your account drops to $9,000, the bot recalculates. 2% of $9,000 is $180. The bot automatically reduces the trade size. It plays defense. It makes it mathematically harder to blow up the account because the smaller your account gets, the smaller your bets become. This is the anti-martingale approach, and it ensures survival during the inevitable drawdown periods that every strategy faces. But how do you determine that percentage? Is 2% the right number? Is it 5%? Is it 0.5%? Enter John Larry Kelly Jr., a scientist at Bell Labs in the 1950s. He developed a formula originally intended to analyze signal noise in telephone lines, but it was quickly adopted by gamblers and eventually by quantitative traders. It is called the Kelly criterion. The Kelly criterion answers one specific question. Given a known probability of winning and a known payoff ratio, what is the optimal fraction of my bankroll to bet to maximize the geometric growth rate? The formula is F asterisk operator sad face BP minus Q/B, where asterisk operator is the fraction of the bankroll to wager. B is the decimal odds received on the wager, the reward to risk ratio. P is the probability of winning. Q is the probability of losing 1p. Let's apply this to a realistic trading bot scenario. Suppose you have a trend-following bot. It has a win rate P of 40%. It has a loss rate Q of 60%. But it has a reward to risk ratio B of 2 to 1. It wins $200 for every $100 it risks. Let's plug it in F. Asterisk operator. Sad face 2 asterisk operator 0.40 minus 0.60 slash 2F. Asterisk operator. Sad face 0.80 minus 0.60 slash 2F. Asterisk operator. Equals 0.20 slash 2F. Asterisk operator. Equals 0.10. The Kelly criterion suggests you should risk 10% of your account on every trade to maximize growth. Now pause. 10% risk per trade is an insane amount of volatility. If you hit a losing streak of 4 trades, which is statistically common, you would suffer a massive drawdown. The Kelly criterion is mathematically optimal for growth, but it ignores human psychology and the risk of ruin. It assumes you have infinite emotional resilience and perfect knowledge of your win rate. In the real world, the full Kelly number is often considered too aggressive. It is a wild ride. So professional traders use what is called fractional Kelly. They might use half Kelly, risk 5% in our example, or quarter Kelly, risk 2.5%. This gives you a significant portion of the growth potential, but drastically smooths out the volatility curve. It keeps your blood pressure low enough to let the bot run. Implementing a quarter Kelly logic into your bot settings transforms it. You are no longer guessing. You are using the bot's own historical performance data, win rate and risk-reward ratio, to scientifically determine the bet size. However, there is a catch. The Kelly criterion relies on the past predicting the future. It assumes your win rate will stay at 40%. What if the market changes and your win rate drops to 30%? Now your position sizing is too aggressive and you are bleeding chips. This leads us to the final stress test for any bot, the Monte Carlo simulation. When you look at a backtest, you are seeing only one version of history. You are seeing the specific sequence of wins and losses that happened. Win, win, loss, loss, win. But the sequence is random. Could easily have been loss, 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 win, 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 win. The end result, net profit, might be the same, but the journey is very different. In the second scenario, you start with 3 losses in a row. If you are risking too much, those first 3 losses might trigger a psychological panic or a margin call before you ever get to the wins. A Monte Carlo simulation takes your bot's trade history, say 1,000 trades, and shuffles them randomly thousands of times. It deals the deck of cards in every possible order to see what is the worst possible drawdown this strategy could theoretically produce. Shutterstock. Explore. You might find that in the original backtest, the drawdown was only 15%. But the Monte Carlo simulation reveals that in 5% of the shuffled scenarios, the drawdown hit 45%. Are you prepared for a 45% drawdown? If not, you must reduce your position size. The simulation exposes the hidden risks that a linear backtest hides. It shows you the ghosts of what could have happened and what might happen next. So you have a bot. You have checked the broker execution. You have avoided the martingale trap. You have calculated your position size using a conservative quarter Kelly approach. You have run a Monte Carlo simulation and you are comfortable with the worst-case scenario. You are now in the top 1% of retail algorithmic traders. You have built a fortress around your capital. But there is still one thing that can breach the walls. There is one force in the Forex market that ignores technical analysis, ignores support and resistance, and can move prices 100 pips in a single second, slipping past your stop losses and shattering your models. It is the force of fundamental reality. Most AI bots are technical. They look at charts. They look at math. They do not look at the news. They do not know that the Federal Reserve Chairman is walking up to a podium to announce an interest rate hike. They do not know that a war has just started in Eastern Europe. When these black swan or gray rhino events occur, the correlations that your bot relies on fall apart. The RSI doesn't matter when a central bank intervenes. In the next part, we are going to look at the blind spot of technical algorithms, the news. We will explore how news filters work, why you absolutely must have one, and how the most advanced bots in the world actually read the news headlines to make trading decisions before the price even moves. Imagine you are driving a car down a highway at 70 miles per hour. But there is a catch. The windshield is painted black. You can't see what is in front of you. You can only drive by looking in the rearview mirror. You can see the curves you just passed. You can see the traffic behind you. As long as the road ahead looks exactly like the road behind you are fine. You can steer perfectly. This is exactly how a technical analysis bot operates. It drives by looking in the rearview mirror. It calculates moving averages, RSI, and Bollinger Bands based entirely on what has already happened. It assumes that the future will be a statistical echo of the past. But then, the road suddenly turns 90 degrees to the left. The rearview mirror doesn't show the turn until you have already crashed through the guardrail. In the financial markets, that 90-degree turn is called fundamental news. And it is the single greatest destroyer of technically sound algorithms. Let's look at the mechanics of a news crash. Every month, the US releases the Non-Farm Payrolls (NFP) report. This is a measure of how many jobs the US economy added or lost. It is a high-impact data point that tells the world if the US economy is heating up or cooling down. Imagine your bot is running a mean reversion strategy on the euro to US dollar pair. It is 8:29 a.m. on a Friday. The market is quiet. The bot identifies that the price is at a strong resistance level of 1.1000. Historically, the price has bounced off this level 5 times in the last week. The math says sell. The probability of a reversal is 80%. So, the bot opens a short position with a tight stop loss at 1.1010. It is a textbook trade. At 8:30 a.m., the NFP report is released. The numbers are shocking. Far more jobs were added than expected. This implies the Federal Reserve might raise interest rates. Instantly, algorithms at major banks dump the euro and buy the dollar. In 1 second, the price doesn't just move down, it teleports. It might jump from 1.1000 to 1.0950 in a single tick. But wait, your bot was short, betting on the price to go down. You should be rich, right? Wrong. Because in that same millisecond, the liquidity vanished. The major banks pulled their limit orders from the market to protect themselves from uncertainty. The spread, the difference between the buy and sell price, exploded from 1 pip to 50 pips. Even though the price went in your direction, the widened spread might have triggered your stop loss before the price moved, or the broker might have been unable to close your profit trade until the price bounced back. Or consider the opposite scenario. The news is bad for the dollar. The price rockets up. It blows past your stop loss at 1.1010. But because there is no one willing to sell at 1.1010, your order is not filled. The next available price is 1.1050. Your 10 pip loss instantly becomes a 50 pip loss. This is called slippage on a stop, and no amount of technical code can prevent it. The bot's logic was perfect, but the reality of the market event rendered the logic irrelevant. This is why every professional-grade bot must have a news filter. A news filter is not a trading strategy. It is a safety switch. It connects to an economic calendar API, a data feed that lists all scheduled global economic events. The bot checks this calendar constantly. You configure it with a rule. If a high-impact, red folder, event is scheduled for the US dollar in the next 60 minutes, do not open new trades. And if there are existing trades, close them or tighten the stop loss. This sounds simple, but the implementation is critical. A basic news filter might just stop the bot from entering, but a sophisticated manager will analyze the risk of open positions. If you are holding a trade that is slightly in profit, and the Federal Reserve Chairman is about to speak, the smart move is to exit. The potential for a random violent spike outweighs the potential for technical follow-through. It is better to be out of the market wishing you were in, than in the market wishing you were out. However, the retail news filter has a major limitation. It only knows about scheduled news. It knows the time of the NFP release. It knows the date of the ECB meeting. It does not know about the unexpected. It does not know that a war has just broken out. It does not know that a pipeline has exploded. It does not know that a president has tweeted something controversial. This brings us to the frontier of algorithmic trading, natural language processing, NLP, and sentiment analysis. This is where the institutions leave the retail traders in the dust. Hedge funds and high-frequency trading firms do not just look at calendars. They have news reading algorithms. These bots are connected to Bloomberg terminals, Reuters feeds, and even social media APIs like X/Twitter. They scan thousands of headlines per second. They are not looking for numbers. They are looking for words. They are trained to recognize semantic tokens. Words like halt, sanction, rate hike, inflation, crisis, or agreement. Let's create an imagine if scenario to illustrate the speed difference. Imagine the central bank governor gives a speech. In the middle of the speech, he deviates from the script and says, "We may need to pause interest rate hikes sooner than expected." To a human listener, it takes about 2 to 3 seconds to hear the sentence, process the meaning, dovish equals sell currency, open their trading app and click sell. An NLP bot reads the closed captions or the transcript feed. It identifies the keywords pause and sooner. It calculates a dovish sentiment score of 0.9. It executes a sell order. Total time, 15 milliseconds. By the time your finger hovers over the mouse, the NLP bots have already sold billions of dollars, driving the price down. You are selling at the bottom of the move, providing liquidity for them to take their profit. You are reacting to the explosion. They are the ones lighting the fuse. Retail traders generally cannot access this level of speed or data processing. The cost of a Bloomberg terminal alone is $24,000 a year, and the custom NLP infrastructure costs millions. So what can you do? You must accept that you are the dumb money in the room regarding news. You cannot beat the news bots. Therefore, your only viable strategy is avoidance. Your bot should be a ghost when the news hits. It should be offline. It should be flat. There is one more danger zone regarding time that destroys bots. The weekend gap. The Forex market runs 24/5. It closes on Friday afternoon New York time and opens Sunday afternoon, Monday morning in Asia. During those 48 hours of closure, the world does not stop. Elections happen. Disasters happen. Deals are signed. When the market opens on Sunday, the price adjusts instantly to all the news that happened over the weekend. If the euro closed at 1.0500 on Friday, and something bad happened in Europe on Saturday, the market might open on Sunday at 1.0400. If your bot left a trade open on Friday with a stop loss at 1.0480, that stop loss is useless. The price never hit 1.0480. It jumped right over it. You are filled at the opening price of 1.0400. You lost 100 pips instead of 20. Because of this, a robust AI bot strategy often includes a Friday exit module. No matter what the technicals say, even if the chart looks beautiful, the bot forces all trades to close at 4 p.m. on Friday. It cleans the slate. It refuses to hold risk during the time when it cannot act. So, we have built a comprehensive picture. We have a bot with a logical strategy, honest backtesting, proper position sizing, Kelly criterion, and a strict news filter to avoid the fundamental blind spot. But we have one final physical problem. Where does this bot live? Is it running on your laptop? The laptop that goes to sleep when you close the lid? The laptop that relies on your home Wi-Fi, which disconnects when the microwave runs? The laptop that performs a Windows update and restarts automatically in the middle of the night? If your bot is running on your home computer, you are running $1 million logic on a $10 infrastructure. A 5-minute internet outage at your house during a trade could mean the bot fails to send a close signal, turning a winner into a catastrophic loser. To be a serious algorithmic trader, you need to sever the link between your physical location and your trading execution. You need your bot to exist in the cloud, running on a server that never sleeps, never disconnects, and sits physically next to the exchange. In the next part, we are going to talk about the hardware of the ghost. We will discuss virtual private servers (VPS), the concept of colocation, and why being 5 milliseconds closer to New York can save you thousands of dollars a year. You are sitting in your home office. You have a powerful gaming computer, 3 monitors, and a high-speed fiber internet connection. You feel professional. You feel ready. But in the ruthless mathematics of algorithmic trading, you are operating from a shack in the wilderness. To understand why your home setup is a liability, we have to look at the physical journey of a data packet. When your bot on your home computer sends a buy order, that signal has to travel from your computer to your router, then to your ISP's local hub, then through a series of regional nodes, then under the ocean via fiber optic cables, and finally to the broker server. This journey is called the last mile, and it is where retail traders lose millions of dollars every year without ever realizing it. In the world of networking, distance is measured in milliseconds. This is your ping, or latency. If you are in California and your broker's server is in New York, the speed of light dictates that your signal cannot arrive instantly. It has to travel 3,000 miles. On a good fiber connection, that might take 40 to 60 milliseconds. That sounds fast. To a human, 60 milliseconds is imperceptible. Takes you 300 milliseconds just to blink your eye. But to a high-frequency trading HFT algorithm sitting in New York, 60 milliseconds is an eternity. It is enough time for them to analyze the market, execute a trade, move the price against you, and sell it back to you at a higher rate before your order even arrives at the door. You are playing a video game where your opponent sees you 3 seconds before you see them. You are dead before you spawn. This is why professional algorithmic traders never ever run bots from their homes. They use what is known as a virtual private server or VPS. A VPS is essentially a slice of a powerful industrial server that you rent. It runs a version of Windows or Linux just like your home PC, but it doesn't have a monitor, a keyboard, or a mouse. You access it remotely through your home computer. You log in, install your trading platform like MetaTrader or CTrader, load your bot, and then you disconnect. When you disconnect, the VPS keeps running. It doesn't care if you turn off your laptop. It doesn't care if your home Wi-Fi drops. It doesn't care if there is a blackout in your neighborhood. It exists in a climate-controlled data center with backup generators, redundant internet lines, and 24/7 security. It is the ghost we spoke of earlier, an entity that lives in the cloud, tirelessly executing your logic. But not all VPSs are created equal. If you rent a cheap VPS in Texas, but your broker's server is in London, you haven't solved the latency problem. You have just moved the problem to Texas. This brings us to the concept of colocation. This is the gold standard of infrastructure. The financial world has physical centers of gravity. For the US market, the center of gravity is a specific building in Secaucus, New Jersey, known as Equinix New York 4. This massive data center houses the servers for many major stock exchanges, liquidity providers, and forex brokers. For the European market, the hub is Equinix LD4 in Slough, just outside of London. When you choose a VPS provider, you must ask one question. Where is the physical machine? You want your VPS to be in the exact same building, ideally in the exact same room as your broker's server. When you achieve this, you eliminate the internet almost entirely. Your order travels through a fiber optic cable within the building, sometimes just a few meters long. This is called a cross-connect. Shutterstock. Explore. With colocation, your latency drops from 60 milliseconds to 1 millisecond or 2 milliseconds. You are now executing at the speed of the institutions. Let's calculate the financial value of those 58 milliseconds. We return to the concept of slippage. In a volatile market, price can move 0.1 pips every 10 milliseconds. If you are delayed by 60 milliseconds, the price might move 0.6 pips against you before your order fills. If you are trading a strategy that targets 5 pips of profit, losing 0.6 pips to latency means you are losing 12% of your total revenue on every single trade. Imagine you trade 1,000 times a year. 1,000 trades x 0.6 pips slippage equals 600 pips lost. If you are trading one standard lot, $10 per pip, that is $6,000 of pure profit that you incinerated simply because your signal was too slow. A high-quality New York 4 VPS might cost you $30 a month, $360 a year. By spending $360, you save $6,000. This is the highest ROI investment you can make in your trading business. It is not about buying a better bot. It is about giving your current bot a fair fight. Now let's look at the imagine if scenario of reliability. This is the nightmare that wakes traders up in a cold sweat. Imagine you are running a martingale bot, which, as we discussed, is risky, but let's assume you are doing it. The bot has opened a basket of 5 trades. The market is moving against you. The bot needs to open the 6th trade to average down and survive. This 6th trade is critical. It is the lifeline. At that exact moment, your home internet flickers. Maybe your ISP is doing maintenance. Maybe a storm knocks out a line. Your connection drops for 30 seconds. In those 30 seconds, the price hits the level where the bot should have bought. The bot screams buy inside your computer, but the signal cannot leave the house. The price keeps dropping. By the time your internet comes back, the opportunity is gone. The math is broken. The basket fails. You get a margin call. A VPS protects you from the chaos of domestic life. It protects you from the cat pulling the power cord. It protects you from your spouse streaming 4K video and hogging the bandwidth. However, even a VPS has risks. There is a phenomenon called the zombie bot. Sometimes software crashes. MetaTrader might freeze. The VPS itself is fine, the internet is fine, but the application has locked up. The bot is technically on, but it isn't reading data. It is a zombie. If this happens while you have open trades, you are flying blind. You might think your bot is managing the position, but in reality, your position is drifting toward a cliff and the pilot is unconscious. Professional setups use watchdog software. This is a separate script that monitors the health of the trading terminal. If it detects that MetaTrader hasn't updated a price in 30 seconds, or if the memory usage spikes, the watchdog automatically kills the program and restarts it. It sends you an alert to your phone. Terminal restarted. This redundancy is crucial. You cannot trust software to run forever without hiccups. Entropy affects code just as it affects the physical world. We also need to discuss spread recorders. When you run a bot on a VPS, you should also run a tool that records the live spread and slippage of every trade. This is your black box flight recorder. If you notice that your bot is losing money, you check the logs. You might see that your broker is executing your trades in 200 milliseconds, even though your ping to the server is 2 milliseconds. This is the smoking gun of a B-book broker using a virtual dealer plugin to artificially delay you. Without the VPS logs, you have no proof. With the logs, you have evidence. You can confront the broker or, more likely, move your money to a better one. So, you have the strategy. You have the risk management. You have the news filter. You have the VPS in the New York 4 data center. You have the watchdog. The machine is humming. It is perfect. Or is it? There is a concept in data science called drift. The market is not a static environment. The patterns that worked in 2023 might not work in 2025. Volatility regimes change. Correlations flip. A bot that is profitable today will, with 100% certainty, become unprofitable in the future if it is left alone. Most beginners set and forget. They turn the bot on and walk away, expecting it to work forever. This is financial suicide. A professional algorithmic trader is not a pilot, they are a mechanic. They are constantly tuning the engine. But how do you tune it without breaking it? How do you know if a losing streak is just bad luck, or if the strategy is actually broken? How do you re-optimize the parameters without falling back into the trap of curve fitting that we discussed in part 1? There is a scientific method for this. It is called walk-forward analysis. It is the rigorous process of testing a strategy on past data, verifying it on out-of-sample data, and then rolling that window forward to simulate real-life adaptation. It is the only way to keep a bot alive for years instead of months. In the next part, we are going to enter the workshop. We are going to learn how to perform a walk-forward analysis, how to detect alpha decay before it kills your account, and how to decide when to retire a bot and replace it with a new one. Think of a trading strategy like a carton of milk. It has an expiration date. When you buy a bot or when you finish coding one, it is fresh. It matches the current market conditions perfectly. It understands the current volatility, the current correlations, and the current geopolitical temper. But from the moment you turn it on, the clock starts ticking. The market begins to rot the logic. This phenomenon is called alpha decay. It is the inevitable erosion of a strategy's edge over time. It happens for 2 reasons. First, market efficiency. If a strategy is too profitable, other traders and big banks will discover it. As billions of dollars chase the same entry signal, the price moves before you can get in, and the profit margin vanishes. Second, regime change. A strategy built for a low interest rate environment like 2010 to 2020 will often catastrophically fail in a high inflation, high interest rate environment like 2022 to 2023. The fundamental physics of the market shift, rendering the old maps useless. Most retail traders treat a bot like a set-and-forget appliance like a refrigerator. They plug it in and expect it to keep things cold forever. But a professional treats a bot like a Formula One car. The setup that wins on the straight tracks of Monza will guarantee a crash on the winding streets of Monaco. You cannot run the same settings in December that you ran in August. You have to adapt. But how do you adapt without guessing? If you just tweak the settings every time you lose, you are emotionally tampering. You are chasing the market. The scientific solution to this problem is a rigorous testing method called walk-forward analysis. To understand walk-forward analysis, we have to look at how most people fail. Most people do a static backtest. They take data from 2020 to 2024, optimize the parameters to find the best settings, and say, these are the best settings for the last 4 years, so they are the best settings for next month. This is a lie. Those settings are an average of the last 4 years. They are not tuned for now. Walk-forward analysis breaks the timeline into moving windows. It simulates the life of a trader who is constantly re-optimizing.
Immagine a timeline.
Step 1. The in-sample window. You take data from January to June. You ask the computer, what were the best settings for this period? The computer says, RSI 14 and stop loss 20. Step 2. The out-of-sample window. You take those exact settings, RSI 14, SL 20, and test them on July. July is data the computer has never seen during the optimization. It is a blind test. Step 3. The walk. You move the window forward. Now you optimize from February to July. The computer finds new settings, RSI 18, stop loss 25. You test those new settings on August. You repeat this process for the entire history of data. January to June July test. February to July August test. March to August September test. What you get at the end is a stitched track record. It shows you how the strategy would have performed if you had re-optimized it every single month based on the recent past. This is the only honest way to backtest. It tests the robustness of the adaptability, not just the static parameters. If your walk-forward analysis shows a profit, it means your strategy has genuine predictive power. It means the immediate past is a reliable predictor of the immediate future for your specific logic. But if the walk-forward crashes, it means your strategy is just curve-fitting noise. It means that what worked in June has zero relationship to what works in July. Let's look at a case study of how this saves your bank account. Consider the Asian session scalper. This is a very popular genre of bot. It trades the euro to US dollar during the quiet Asian hours, between the New York close and the London Open. It bets that the price will stay in a narrow range. In 2019, volatility was dead. The Asian scalper printed money. If you ran a static backtest on 2019 data, it looked like a gold mine. Then came 2020. The pandemic hit. Volatility exploded. Even the quiet Asian session saw 50 pip moves. A trader running the static 2019 settings in 2020 would have been wiped out in a week. The stop losses were too tight for the new regime. But a trader using walk-forward analysis would have seen this coming. In the optimization window of late 2019, the computer would have detected the rising volatility. It would have adjusted the stop losses wider, or perhaps it would have stopped trading entirely because the out-of-sample tests for January and February 2020 would have started failing. The walk-forward process acts as a canary in the coal mine. It tells you, the parameters that used to work are no longer working in the forward tests. Stop the bot. This leads to the concept of parameter stability. When you run these optimizations, you are looking for cluster analysis. Imagine you are testing the stop-loss setting. The optimizer tells you that 50 pips is the most profitable setting. But then you look at the neighbors. 48 pips loss. 49 pips loss. 50 pips. Huge profit. 51 pips loss. 52 pips loss. This is a spike. It is a dangerous, fragile anomaly. If the market shifts even slightly, you fall off the peak into the valley of losses. You do not want this. You want a plateau. 48 pips. Good profit. 49 pips. Good profit. 50 pips. Best profit. 51 pips. Good profit. 52 pips. Good profit. This shows that the strategy is robust. It doesn't need to be perfect to work, it just needs to be close. We are looking for strategies that are roughly right, not precisely wrong. Now let's talk about the retirement decision. Even the best strategy optimized with walk-forward analysis will eventually die. The market will change so fundamentally that the logic itself, not just the settings, becomes obsolete. How do you know when to pull the plug? You need a metric called the efficiency ratio, or the robustness ratio. You compare the performance of the bot in the optimization window in sample to the performance in the test window out of sample. If the bot makes $1,000 in the training phase but only $100 in the testing phase, your efficiency is 10%. This is poor. It means the strategy is overfitting. The model is memorizing the past but failing to predict the future. If the bot makes $1,000 in training and $600 in testing, your efficiency is 60%. This is excellent. It means the logic holds up well against the unknown. You monitor this ratio live. As you run the bot with real money, you are essentially in a permanent out-of-sample test. You compare your live results to your backtest forecasts. If your backtest predicted a maximum drawdown of 15%, and your live account is currently down 16%, you have a model breach. This is the red alert. It does not mean you are unlucky. It means the model is broken. Most retail traders say, "I'll give it a little more room. It will bounce back." The professional says, "The statistical boundary has been breached. The probability of this being a normal event is less than 1%. Therefore, the market regime has shifted." They kill the bot immediately. They do not wait for the margin call. They preserve the remaining capital to fight another day with a new, recalibrated strategy. This brings us to the portfolio approach. You should never rely on a single bot. You need a team of bots. You want a trend follower that makes money when the market moves big. You want a mean reversion bot that makes money when the market does nothing. You want a news breakout bot. When the market trends, your mean reversion bot will lose, but your trend follower will win big. They offset each other. The goal is to smooth out the equity curve so that the combined portfolio is more stable than any single component. But here is the catch. Managing a portfolio of bots, performing monthly walk-forward optimizations, monitoring latency, checking for drift, and handling the psychological pressure of watching multiple strategies fluctuate. This is not passive income. This is a job. It is a business. It requires discipline, data literacy, and an iron stomach. We have spent 9 videos dismantling the marketing lies. We have looked at the code, the brokers, the math, the hardware, and the optimization cycles. You now possess the technical roadmap that 99% of traders ignore. You know more than the person selling you the guaranteed gold bot. But there is one final variable we haven't discussed. And it is the most volatile variable of all. It is the variable that sits in the chair in front of the screen. It is you. Why do traders who have profitable bots still lose money? Why do they intervene? Why do they turn off the bot right before the winning streak? Why do they increase the risk after a win? In the final part of this masterclass, we are going to look at the human in the loop. We are going to discuss the psychology of automation, the future of AI in retail trading, and I will give you the final unvarnished truth about what it really takes to survive in this arena for the next 10 years. This is the end of the technical deep dive. Next, we enter the mind. You are the ghost in the machine. After 10 videos, after thousands of words discussing latency, backtesting, spread manipulation, and neural networks, we arrive at the most uncomfortable truth of all. The reason most algorithmic traders fail has nothing to do with the algorithm. You can have the perfect code, the fastest VPS in the New York 4 data center, and the most robust risk management plan, and you will still find a way to lose money. Why? Because you are human. And the market is designed to exploit your biology. There is a profound psychological difference between manual trading and automated trading. When you trade manually, you feel in control. If you lose, you can blame a specific decision you made. You can say, "I pulled the trigger too early." There is a sense of agency. But when you turn on a bot, you surrender that agency. You become a passenger in a car driven by a math equation. When that car starts swerving, when the bot enters a drawdown, you experience a unique form of anxiety. It is the anxiety of helplessness. You watch the screen. You see the floating loss grow. Minus $500, minus $1,000, minus $1,500. Your pulse quickens. Your amygdala, the primitive part of your brain responsible for the fight or flight response, screams at you to do something. Stop the pain, it says. Close the trade. Save the remaining money. So you intervene. You click close all. You breathe a sigh of relief. The pain is gone. You saved your account. Then, 10 minutes later, the market reverses. The price goes exactly where the bot predicted it would go. If you had just sat on your hands and done nothing, that minus $1,500 loss would have turned into a $2,000 profit. By intervening, you didn't just take a loss. You destroyed the statistical expectancy of the system. You broke the law of large numbers. This is the intervention trap. The moment you override your bot based on fear, you are no longer an algorithmic trader. You are a discretionary trader with expensive software. You have rendered your backtests worthless because your backtests assumed the bot would take every trade, every time without hesitation. They did not account for a terrified human hovering over the mouse button. Conversely, there is the greed trap, often triggered by a winning streak. Imagine your bot wins for 3 months straight. You feel like a genius. You think you have solved the market. The dopamine hits are addictive. You look at your risk settings. I'm only risking 1%, you think. If I risked 5%, I could buy a Lamborghini by Christmas. So you change the settings. You crank up the leverage. You ignore the Kelly criterion we discussed in part 6. You drift into arrogance. And the market, which is cyclical by nature, waits for this exact moment to shift regimes. The moment you increase your risk is almost statistically guaranteed to be the moment the winning streak ends. The subsequent drawdown, now amplified by your greed, wipes out all the previous profits in your initial capital. The bot didn't fail. Your discipline failed. So what is the solution? How do you survive the psychological torture of automation? You must treat trading as a business, not a video game. A casino owner does not run down to the roulette table and scream every time a player wins a bet. The owner knows that over 10,000 spins, the house edge guarantees a profit. The owner looks at the monthly spreadsheet, not the individual spin. You must detach yourself from the daily P&L. If you are checking your bot on your phone every 10 minutes, you are already losing. You are emotionally compromised. The best algorithmic traders check their systems once a day, or even once a week, simply to ensure the technical infrastructure is running. They trust the math more than they trust their feelings. Now let's look forward. What does the next decade hold for retail algorithmic trading? We are standing on the precipice of a revolution that will make the tools we use today look like stone tablets. Generative AI and large language models, LLMs, are about to democratize coding. In the past, if you had a brilliant trading idea, you needed to learn C++ or MQL4 to build it. You had to be a programmer. Today, you can ask an AI to write a mean reversion script for MetaTrader 5 that uses Bollinger Bands and a trailing stop, with a news filter. It will write the code for you in seconds. This lowers the barrier to entry to zero. This sounds great, but it creates a new danger: the noise explosion. The market is about to be flooded with millions of AI-generated bots. Most of them will be terrible, created by people who don't understand market structure. This will create massive chaotic volatility. The signal-to-noise ratio in the market will degrade. However, for the sophisticated trader, this is an opportunity. As AI gets better, we will move away from static rules. If RSI greater than 70, sell, toward dynamic adaptation. We will see the rise of reinforcement learning bots in the retail space. These are bots that do not have fixed rules. They have a goal, make profit, and a penalty, lose money. And they play millions of simulations against themselves to figure out the optimal strategy. They learn like a human learns chess, but millions of times faster. We will also see the integration of alternative data. Right now, you trade based on price and time. In 5 years, your retail bot might have access to satellite imagery of oil tankers to trade crude oil, real-time credit card transaction data to trade retail stocks, and sentiment analysis of millions of social media posts to trade crypto. The edge will not be in the algorithm, the edge will be in the data you feed it. But be warned, the institutional sharks are evolving too. They are moving toward quantum computing. A quantum computer can calculate probability scenarios in seconds that would take a traditional supercomputer 1,000 years. When this technology goes live in the HFT space, the concept of latency will change again. The retail trader will be pushed further out to the longer time frames. You will not be able to compete in the millisecond time frame. You will have to compete in the hourly or daily time frame, where smart money moves slower. So here is your roadmap. Here is the unvarnished truth of what you need to do to survive and thrive in this arena. First, stop looking for the holy grail. It does not exist. Stop buying $50 bots from Instagram ads. Stop believing in 100% win rates. Second, become a student of market structure, not just code. You cannot automate what you do not understand. You need to know why the price moves before you can tell a machine to trade it. Third, build your infrastructure. Get the VPS. Get the ebook broker. Get the high-quality tick data. Do not build a skyscraper on a foundation of mud. Fourth, master the science of testing. Learn walk-forward analysis. Learn to run Monte Carlo simulations. Be a skeptic. Assume every strategy is broken until it proves itself to you with statistical rigor. Fifth, diversify. Do not bet your life savings on one robot. Build a portfolio of uncorrelated strategies. Be the manager of a team of bots, not the lover of one. And finally, master yourself. Understand that the hardest part of algorithmic trading is not the coding. It is the waiting. It is the discipline to let the law of large numbers play out. It is the courage to accept a losing month without changing the strategy, and the wisdom to recognize when a strategy is truly dead. The era of the get-rich-quick scheme is over. The era of the get-rich-slow via applied mathematics and data science has begun. You have the tools. You have the knowledge. You have seen behind the curtain. The black box is open. The machine is ready. The question is, are you? This concludes our deep dive masterclass on AI Forex trading bots. The chart is open. The market is moving. The rest is up to you.